Michael Burry, who many know as the guy in this movie, is not the kind of man who is afraid to put his reputation on the line by making bold economic predictions. He has done it many times over the years, and the scary thing is that he usually turns out to be right. In 2006 and 2007, he was ridiculed by investors when he predicted the collapse of the U.S. housing market, but in 2008 he turned out to be 100% right. In February 2021, he predicted a massive spike in U.S. inflation at a time when, according to the latest data, the inflation rate was less than 2%. Let's move to today, right? And again, in July 2021, he predicted the greatest speculative bubble of all time. What do you know? Stocks and cryptocurrencies collapsed during 2022. In September 2022, he predicted a white-collar recession, and look what we have now. Mass layoffs are happening all over the technology sector. This guy certainly knows how to make good predictions, and he recently made another bold prediction. And I'm not going to lie that this latest prediction, if it turns out to be correct, will have more serious economic consequences than anything he has said in the last few years. So what is his stock market prediction for 2023? Well, let's find out. Michael Burry has continued to rage on Twitter over the last month or so. And interestingly enough, it seems at least now, he's no longer deleting his tweets. So it's much easier for us to follow him now. But staying on topic, on January 2, Burry shared with us his thoughts on the economic situation we're all going to see over the next few years. And here's what he had to say. Quote, "Inflation has peaked. This is not the last peak of the cycle. We are likely to see a decline in CPI, and probably negative in the second half of 2023. And the U.S. is in a recession by any definition. The Fed will cut, the government will stimulate printing money, and we will have a spike in inflation." It's not complicated. I'm always amused by the confidence with which Burry makes these predictions. Come on, guys, it's not that hard. Of course it's going to happen, although I must apologize. Michael, I hope you're wrong, because, in fact, Burry predicts that the current downward trend in inflation that we're seeing is just the end of the first wave of inflation. And we're likely to see several more waves of inflation over the next few years because the Federal Reserve doesn't have the willpower to keep rates high. Yes, it could potentially cause a recession, but keep rates high and thereby suppress inflation once and for all. And the reason this potential situation immediately sends shivers down investors' spines is because it would be the same scenario that happened in the 1970s. But first of all, a little context about what the heck is going on. Over the last few years, we've seen a combination of supply chain problems and money printing. And both of those things together have caused inflation to spike to its highest level in 40 years. This has forced the U.S. Federal Reserve to go to higher interest rates in order to slow the economy, limit the ability of citizens and businesses to access borrowing, and thereby limit spending. But of course, this also causes the economy to slow down, and everyone finds themselves under increased financial pressure. It is essentially a choice of the lesser of two evils. Do you want to just let inflation run rampant and everything become increasingly unaffordable? Or do you want to raise interest rates and impose financial hardship on your nation for a period of time to suppress demand for goods and services, which will force inflation to calm down? History tells us to do just that. And what we saw in 2022 is that the Fed raised rates to 4.5% from near 0%. And yet inflation is now trending downward. But here's the thing. People do suffer in periods of high interest rates. They're not too high now, but they're projected to continue rising through 2023. And high interest rates mean that for people, debts like mortgages and personal loans eat up more and more of their disposable income until they have no money left to spend on other things. So the decision to keep interest rates high for a long time is certainly not a popular one. Inevitably, therefore, there is strong political pressure from the public to lower interest rates. After all, lower interest rates make people feel better, and politicians want to make people happy. Besides, the chairman of the Federal Reserve is appointed by the president. So all the political pressure is to get rates lowered. But if this is done prematurely, inflation could skyrocket. And then for all the financial pain you have caused by trying to stop inflation, you will be out of luck. The problem will not be solved, and you will be back to square one. That's exactly what happened in the 1970s. In 1970, inflation crept up to the 5% mark, and the effective federal funds rate was then 9%. So what do you know? Inflation dropped to 3% and the Fed lowered interest rates, but in 1974 inflation crept back up to 11% and then rates were raised again, this time to 13%. Eventually, inflation fell again to 6% in 1976 and the FOMC relaxed again, saying that inflation was going away and cut interest rates again to 5%, but too soon. Inflation soared to 14% in 1980. And it took the intervention of Paul Volcker, who raised interest rates to 20% and unfortunately sent the U.S. into a severe recession for inflation to finally be defeated. This is exactly what Michael Burry predicts for the U.S. over the next few years. He doesn't believe we've learned our lesson, tilting history in his direction. Again, inflation will calm down, rates will remain elevated, the U.S. will fall into recession, people will suffer. The policy will put pressure on the Fed to lower interest rates and stimulate the economy, which will cause the next wave of inflation. You might think that Burry is a little out of touch with such a bold prediction, but interestingly enough, he's not the only famous super investor who has expressed this opinion. Another very famous person you probably know, who also believes that the Fed's willpower won't be strong enough to beat inflation, is Charlie Munger.
When Volcker, after the 70s, took the prime rate to 20% and the government was paying 15% on its government bonds, that was a horrible recession. Lasted a long time, caused a lot of agony. And I certainly hope we're not going there again. I think the conditions that allowed Volcker to do that without an interference from the politicians were very unusual. 2020 hindsight, it was a good thing that he did it. I would not predict that our modern politicians will be as willing to permit a new Volcker to get that tough with the economy and bring on that kind of a recession. So I think the new troubles are likely to be different from the old troubles. You may wish you had a Volcker-style recession instead of what you're going to get. The troubles that come to us could be worse than what Volcker was dealing with.
It is very interesting that Charlie Munger and Michael Burry basically hold this line of thinking. In their view, the political environment that allowed Volcker to be tough and stop inflation in the 1970s may not exist today. And so we may see a period where inflation goes into overdrive because the Fed will get caught in a cycle of trying to lower interest rates and then being forced to raise them again. Although, frankly, Jerome Powell and the Federal Reserve have repeatedly indicated in several press conferences that they are committed to making sure that doesn't happen. So Jerome Powell acknowledged the inflationary cycles of the 1970s and said that the Fed was committed to ensuring that such a situation would not arise this time. I'll show you an excerpt from the latest FOMC press conference and listen to him mention the Fed's failures in the 1970s at the end of the clip. For me, this is the most important quote. Historical experience warns against a premature loosening of policy. We will stay the course until the job is done. So make no mistake, the Federal Reserve is well aware of everything that happened in the 1970s and says they intend not to make the same mistakes again. But while the Federal Reserve is saying all this, Michael Burry's opinion still stands, because the Fed may be saying all this now, but whether they will actually follow it is another question entirely. And that's what both Charlie Munger and Michael Burry are saying. Of course, the Fed wants to get inflation back to the 2 to 3% level. That would be great. But if they have to keep raising and raising interest rates, and it causes a nasty recession, it means that many Americans will lose their jobs and won't be able to afford their mortgages. Will there be enough political willpower to continue and properly control inflation, or will the political pressure be too great to keep people happy and loosen monetary policy, namely to cut rates and print money? As Burry said, we are likely to see CPI decline, possibly negative in the second half of 2023, and the U.S. will find itself in a recession. By any definition, the Fed will cut interest rates. The government will stimulate money printing, and there will be another big spike in inflation. That's Michael Burry's latest prediction, and it certainly matches his previous tweets, that's for sure. In late June, after the stock market collapsed 20%, Burry noted that he thought we were only halfway there. In response on September 7, he said, "No, we haven't bottomed out yet." And earlier he said he expected the S&P 500 to fall below the 2020 COVID lows. So there is no doubt that he is very bearish on the next few years. And it seems that his distrust of the Federal Reserve is the main reason for that. But with that said, guys, please let me know your thoughts and opinions in the comments section below. Do you think the Fed will have the courage to suppress inflation once and for all in 2023? How sticky will inflation be? That's the question. Anyway, guys, please leave a like on this video. If you liked it, subscribe if you want to see more videos like this, and see you in future videos.